specifically, let's go into closing these temporary accounts. So again, this is a process that happens at the end of the period, after doing financial statements, after completing the worksheet. We want to zero out revenue, expense, and dividends account. So by zeroing out, that doesn't mean we're just erasing the information. That simply means that we are transferring those information to retained earnings. Okay, so really this process is just trying to link to statement of retained earnings. So remember that on Monday when we did the worksheet, I briefly mentioned that retained earnings account is the only account on the worksheet that you will see that doesn't have the up-to-date balance. Okay, all the other accounts, cash, accounts receivable, accounts payable, on the worksheet you have all the latest information. Only retained earnings is the account that we haven't actually updated in worksheet, because what goes into this account is all the revenues and expenses information. And we don't know this until we do income statement. Okay, while we do adjusting entries, a lot of the transactions relates to a type of expense, a type of revenue. So retained earnings account is the only one, sort of like an exception on the worksheet, that you don't see an up-to-date balance. You only see the up-to-date balance in the second statement of retained earnings. So what this closing process is trying to do is to match up the ending balance of retained earnings in the T accounts and in the journal entries as well. Because beforehand, before we did the financial statements, retained earnings has not been updated, because at that point of time, we didn't know what was the summary of net income or net loss for the period. Okay, so closing entry, zeroing out, setting revenues, expenses, and dividends back to zero, that simply means we're transferring the amount into retained earnings. And then starting from next season, next month or next quarter, you will be adding new revenues information here, new expenses, new dividends if the company decides to give out any. Okay, so basically what this means is that whenever you look at an income statement, you can have full confidence that what you're looking at, the numbers only relates to that month. If it's a monthly statement, it states, for example, $5,000 of revenues. That's the revenue that you earn in that month. Not in the beginning of the year, not in the month later. It only relates to that month, that period of time of revenues. Same for expenses. The expenses you see on monthly income statement or yearly income statement only relates to the expenses that occurred for that period of time. So meaning it is not an accumulated revenue starting from the beginning of the business. If the beginning of the business was 10 years ago, the revenue is accumulated here, but not in the revenue account itself. Okay, so retained earnings captures the accumulated net income all along the year, transferred here. So revenues and expenses only represent a short period of time of information. So this is why we call them temporary. But this itself is a permanent account. Okay, so everything later on will be transferred here. This retained earnings is the permanent account, but all the other ones, revenues, expenses, dividends, are temporary accounts. Okay, we zero them out by accumulating the earnings to retained earnings account itself. Okay, so by doing this in details, there are 4 steps. There's 4 journal entries, 4 posting steps to do in order to get to the final balance of retained earnings. I actually just mentioned this already. Temporary accounts, we close them by transferring information